Hi, I'm Russ Mayfield, investment strategy analyst at Baird, and we are back for another weekly video with our friends at Strategas. Today, I'm thrilled to be joined by technical strategist Todd Sohn. Todd, how are you doing today?
Hey, Ross, I'm well, and great to speak with you as always.
Great to have you on as well. We're recording on a Thursday in wake of what was, again, one of the hottest inflation prints in 40 plus years, 9.1% for CPI. And there's a lot of takeaways from the report, but I'll just turn it over to you. How are you all thinking about inflation at this point in the wake of that report?
Yeah, it's a great question. Another hot reading, as you mentioned. And I think the big picture here is keep what's most important in mind here, in that, there was some noise following the report in terms of how different asset classes traded, but the larger trends are still in place. Stocks are still in a bear market, and we know bear market rallies can be vicious. They can be very short-lived. If you're trying to play this tactically, you have to keep the leashes tight on all of your positions. And also, the dollar continues to strengthen. You're at fresh highs this morning. You have the yen at 20-some-odd years high. The euro's at parity. The pound is at fresh two-year lows. And even Canadian dollar also starting to weaken. So, I will see what happens with next month's report and how the economics progress from here. But the major macro trends are still in place. I would not fight those. I think the one question mark is, where do rates go from here? And they're just pausing. They've had a huge run. Bonds have had a very significant drawdown. We're looking at this as more of a oversold relief for bonds right now than any major change in trend. But as more data comes in, we'll continue to adjust our thinking.
Yeah, I think that makes a lot of sense. And to your point about the overall trends not changing, this was a report that surprised to the upside, but the Fed was already planning to be very hawkish. So it's, maybe they'll get a little more hawkish, but it doesn't change kind of the larger narrative, I think. So zooming in a little bit from kind of the higher level asset class macro perspective, I wanted to talk sectors with you. You all do a lot of great work on inflows and outflows and what that means as far as investors kind of voting with their dollars. So if you wouldn't mind, could you tell us, what are one or two of the major trends you're seeing from inflows and outflows into ETFs?
Yeah, I'd say on the inflow side, healthcare has really taken a leadership baton here, and that's being reflected in the flow data. It's taken in what's already a record for the sector, $9.6 billion this year, right? And we still have a few months to go in 2022. Notably, that number has already doubled what the next sector, consumer staples, another defensive area, has taken in this year as well. Now, I think the difference with healthcare now is that it's been more of a steady inflow rather than a surge like we saw back in 2018 and 2020, which were the last two major corrections, especially 2020, which was a health crisis. So I think it made sense to allocate towards healthcare in that instance. But we just want to be mindful that as healthcare does assume more and more leadership, that consensus positioning is starting to grow, and that the flow backdrop will continue to be a risk for that space. Now, on the other side of this, in terms of outflows, we're pretty amazed by the amount of outflows from the energy sector over the last month. Yes, the stocks have pulled back sharply, but remember, they're pulling back from a position of strength. They're still home to the best underlying trends within the market. But you've seen a few $1 billion come out of the XLE, the Spider Energy ETF, one of the sharpest outflows we've seen over the last month. And I think it just speaks to how nervous folks are to be allocating towards energy, perhaps a lot of hot money leaving the sector, weaker hands being shaken out. And I think that we're looking at this as a contrarian bullish, right? Extreme outflows with the benefit of good underlying trends. We think once you get through this noisy period of a pullback in energy, that you're going to want to start to allocate and look for those stocks to resume higher. We love it when there's outflows with contrarian attitudes towards areas from a position of strength.
That's awesome. I think that's really good insight. And anytime you can be a contrarian, I think it's something to look at. So I want to end with a question that might be a little bit unfair, but as we kind of, this bear market has been going on for 6+ months now. What is one kind of indicator that you're looking for to say, all right, I don't know if we're at the bottom or not, but I need to see this as part of a package of data that would say we're near or at the bottom?
Yeah, I think that a wonderful question. There's two metrics. One, you have to see unmistakable breadth coming off of a low, right? The percentage of stocks trading to a new 1-month high. When that surges, it's typically consistent with a buy it all attitude. And I want to see that accompanied by risk-seeking leadership. And the main barometer we look at is consumer discretionary versus consumer staples on an equally weighted basis, right? So we eliminate the effects of, say, Amazon and Tesla, the heavyweights within that sector. That's yet to make any sort of progress. Even with commodities coming in, you haven't seen any relief for consumer discretionary stocks. So until you get a breadth surge accompanied by an improving economic outlook via the discretionary versus staples barometer, I would stay very reluctant here, but those are the two metrics and barometers that I would keep an eye on for any sort of progress. But stay tuned here until the back half of the year, and if anything changes.
For sure. And we will stay tuned. We'll have you back before the year is over to get an update on those things. So Todd, thank you so much for the time today. We really appreciate talking to you.
Thanks, Ross. Always a pleasure.